If you want to save on taxes, you want to watch this video. And so as a CPA, I've worked with so many students to apply this to their situation, but it's really, really important to understand what tax loss harvesting actually is, an actual smart framework in which to use this. I want to walk you through some simulations and also an example today. So let's get it to the beginning part, which is what is tax loss harvesting. So this is something that helps investors reduce their taxes, which is a good thing, obviously, by offsetting the amount they have to claim as number one, and in sequential order, the capital gains, and number two, their income. So two different types of taxes, which you have to be aware of. Income tax and capital gains tax are two separate types of taxes, but this is something that can be applied to both situations, which is really key here. So in short, quote unquote, you're harvesting, which is where the name kind of comes about. You're harvesting your investments to sell at a loss, which is obviously not a great idea from an investment standpoint. You don't want to consistently lose money, obviously, right? But then you use that loss to lower or even eliminate the taxes you have to pay on the gains you made during the year. This is a major benefit if used correctly. However, there's an alert I want to share with you guys. So a lot of people are looking at this as an investment strategy. They're looking at their investments and they're thinking, this sounds like a great idea to use as an investment strategy. This is not an investment strategy. This is a tax strategy. You don't want to tinker with your investments a lot, which is why this is awesome, but this also can get people hurt very quickly. There's different things that could happen in a practical sense that people start to use this process, or they calculate things wrong. They do it, they DIY it, and they don't use a professional or work with a professional like myself to actually apply this to their situation. Maybe they miscalculate. Maybe they have a cash drag to where they make one of these sales, but then they don't actually end up rebuying, and there's a major impact on their portfolio long term. So there's a lot of things that go into this. Use an actual professional when you go about doing this. However, this is not an investment strategy. That's a very important piece of this. Now, I'm going to give you a smart framework in which to use. I think this is the most important piece of this whole conversation. So when I say smart, just like the, smart goals, it's a very similar process. So I'm looking at 5 key components when deciding yes or no. There's some rules, there's some conditional logic I'm going to share as well, but let's walk through the 5 components and then we'll walk through the conditional logic behind this. So number 1 is the S of the SMART framework, and we use the size of the loss. So is the unrealized loss at least 5% of the position that you're holding? So what does that actually mean? So let's take a step back for anyone that doesn't understand what I just said or wants to really understand this in layman's terms. So when you're investing, you use a broker like Vanguard, a Fidelity, a Charles Schwab. I talk about this a lot, right? Within those brokers, you select the actual, accounts. So you might have a 401k through work. You might have an IRA. Maybe you have a 529. Maybe you have a taxable brokerage. Maybe you have, all sorts of small business retirement accounts. You have types of accounts, but within each one of those accounts, you have positions. Positions are index funds, ETFs, actual investment products. When I say is the unrealized loss at least 5% of the position, that is what I'm referring to. So let's just say, for example, we have a taxable brokerage account, obviously a non-retirement type of account, and we have an 80-20 split, or at least that's the intended allocation to begin with. Let's say we have 80% VTI, 20% VXUS. That's our initial ideal allocation. Now, throughout the year, international and the US are going to perform differently likely. So international being VXUS, the domestic or US being VTI. So let's just say that 80-20 split, because of different, performances throughout the year, changes to 75-25. At that point in time, you're seeing that actual 20% split go up to 25%, so increase 5%, and you're also seeing your 80% position or VTI go down to 75%. So that's the 5% threshold. Now, I'm not necessarily triggering this right off the bat just because I see a 5% swing. That's not necessarily going to be the case. It could be, it's part of the SMART framework, but it's not the only thing here. It's something to check the box, kind of say yes or no to. So if I go over here and I actually hit the drop down, you guys can use this exact framework. I'm going to say yes for this example. Okay. The next thing is matching gains, which is the M of the SMART framework. So do you have realized gains to offset, or can you use $3,000 loss against income? So this is a pretty, I would say almost guaranteed yes for most people. Here's why: is you might not have realized gains. So when I talk about realized capital gains, this is something where you've sold an investment in a taxable account, which is very key here, because a retirement account, you don't have capital gains. So that's an important, very, very important concept of this whole thing. Let's say in a brokerage account, you do not have capital gains. You haven't actually sold anything. So therefore, you never realized anything. You would not have any capital gains to offset, or the market was doing really bad, obviously. So you have a loss, and that's oftentimes like the reality of this is that your portfolio is going to go up or down together. Of course, you have a diversified portfolio. I get that. But the point is, typically, like if the market, if you have total market ETFs or whatever the case is, if you have a big loss and you're selling, it's likely and highly probable that you don't have gains to match that, just typically. However, if you have an individual stock position, you've sold that, you have a capital gain to offset, there could be a potential play there, obviously. Regardless, there's a high probability you do have income, which then, in fact, if we go back to tax loss harvesting explained, is the second piece of this. So maybe you don't have capital gains, but I almost guarantee you have some sort of income. You might not, like there's a chance you don't, obviously. And in that situation, you'd hit no. But for most people, they're going to say yes because of the second piece of this regardless, even if they don't have the first piece. So it says, do you have realized capital gains to offset? If yes, obviously yes. But then the second part is if you do have income, you can use this up to $3,000 loss against your income, which is a key in the tax loss harvesting calculation. Now, the next piece is the A of the SMART framework. Does the asset still make sense? So this is a really important piece of the conversation because I think the conversation becomes interesting when people are manually DIYing this and they're emotionally deciding in the moment, which is what I typically prevent against by automating your whole entire financial roadmap. I talk about in my national bestseller, the roadmap to financial freedom right here. What we talk about is automating your whole process. So this is a very manual process. And this is something you have to be aware of is if you decide to do this, you got to think of the mindset you're in. You have probably a big loss. The market's probably not doing well and you're probably really emotional. So you got to be really careful that you don't let your emotions dictate your actual judgment here, which is why we use an actual framework. So this question right here, would you still want exposure to this type of investment today? I would make the argument if you've set up your investments and your goal is a long-term investor and you've set them up once and for all, your goal is to build upon this portfolio with time, it probably still makes sense. But again, it just depends. But this is the A, obviously you get to decide, this is why I'm using a framework, but I'm just going to say yes, just hit the drop down. Now, R of the SMART tax loss harvesting framework is replacement timing, which is the wash sale rule. Very important. I'll talk about that in a second. Can you swap into a similar ETF or stock to maintain exposure and avoid the wash sale rule? And so as I talk about down here, the IRS is actually putting up red, like big signs. Like essentially what you can't do in short is if I sold an investment, let's just say I sold VTI, and I registered or realized that gain or that loss, if I realize that loss and I decide to sell out of that position, I can't rebuy it right then and there because everybody would do that. Think about that. You have an investment loss, you sell it at, let's say it's a 20% dip, you calculate or you essentially realize that tax loss, you get the tax benefit, and then you rebuy the same thing. You can't do that. That's the whole point of this, but you can read all the details here in the wash sale rule as well. I'll kind of read through it. So IRS rules prohibit you from claiming a loss if you sell an investment at a loss and then immediately repurchase it. Wash sale. That's the whole point here. So if you buy the same investment or any substantially identical investment, which is a gray box, within 30 days before or after selling at a loss, the loss will be disallowed. Basically, it's saying you're like timing it, trying to play the game, and you're trying to capitalize on two different things, the price and also the taxes. You can't do that. So this is important. And so can you swap for a similar ETF? Sometimes people here, this is the key, is if you went from an 80-20 and it's VTI and VXUS or something similar, that kind of portfolio structure, and it goes to 75-25 and you sell 5% of the heavier weighted type of thing or position and you reverse that and buy the other one to kind of balance yourself back out, you're rebalancing in a sense, then obviously you're in the clear. But if you're trying to buy or sell VTI and rebuy VTI, that's obviously not doable. So let's just say yes for that. Again, we'll get to the simulations in a second. And then the T of this is the time horizon. Is your long-term thesis intact despite the short-term dip? So what this is referring to is exactly what I was saying from an emotional standpoint within the A part of the framework. So your long-term thesis is what this is saying is when you set up your portfolio, you should be willing to accept the risk that comes with that portfolio. So if you're dipping 20%, you should have already known that's potentially going to happen. The risk with that portfolio has the potential to dip 20%, maybe 30%, maybe 40%, depending on how you concoct this portfolio. And so when you have that set up, that's okay, but you have to be aware of that. And so what this is saying is once that does, the risk plays out, which people never think the risk actually plays out. They only see the upside. Oh, I would love to get 10% to deal with a 30% downturn until 30% downturn happens. Right now on April 7th, this is one of the worst days, 3-day stretches in history that we're dealing with as I record this, which is why I'm recording this right this second. When you actually see this video, it'll probably be outside of this window, obviously on a Monday. However, the reason I say that is because we're experiencing this real time. Everybody's changing their plan, quote unquote, and everyone's getting reckless with their decision making. It's very emotional, and this is why my students continue to win. If you want to be one of my students, if you want to take this game to the next level, go in the show notes below and book your free call with my team, and we will take you to the next level. That's what we do here. We position people accordingly for the long term so they win with money, and they guarantee to win with money. That's a bet I will make. I've been right in 2018. I've been right in 2020. I've been right in 2022, and I will be right in 2025. I guarantee it. I'll shake your hand on it. If you follow the fundamentals, you're going to win long term. If you read my national bestseller, The Roadmap to Financial Freedom, A Millionaire's Guide to Building Automated Wealth, you will win long term. So does this impact your long term goal? Obviously, for many people, this would, because of the direction they go after the sale. So the sale itself isn't as big of a deal as what you do after the sale. What you do after the sale to see, does that stay with your thesis or does that change your thesis? Very important piece. So those are the 5 pieces of the smart tax loss harvesting checklist. That's the first piece. So I want you to walk through that and objectively go through each one of those pieces and decide yes or no. Now, the conditional logic is important here because this is really what makes the framework, the rules around the framework. So make the tax loss harvesting transaction, actually make it, green check, if things are present. So you check yes, at least 4 out of 5 of these boxes, with the 2 being non-negotiable, which is S and R of the framework. So then you need a meaningful loss. You don't want to just do this every time the market dips 2%. It needs to at least be greater than or equal to 5% to make harvesting worthwhile. So if you have a 3% dip or 2% swings, like that's not necessarily the time to just do it every single time, because that's going to happen. If you see 5%, and I'm not even saying 5% is the trigger for everything, I'm saying that's the beginning mark of potentially doing this. So that's really important because people could get reckless and they could turn this into something that hurts their investments rather than help their investments. And we want to get the tax benefit from this while not altering anything, which is obviously based on the checklist here. The R is the replacement timing. You must be able to avoid the wash sale rule and maintain your portfolio exposure. That's also important. You're keeping the long-term thesis intact. The wash sale rule is what we learned about right here. So that is the conditional logic to being a yes, essentially making the move. Now, when would you skip this transaction? So if you only check 2 or the 3 items, and especially if either S or R is a no. So if I hit no right here, there's a high probability that I should say no. It wouldn't make sense. So let's say it's a 3%. It's essentially below 5% in this situation. Even if I have realized gains, even if I have $3,000 loss against income, even if I want to, will I want to exposure to this type of investment today? Yes. Can I swap for a similar ETF? Yes. Is this long-term thesis intact? Yes. It's still not large enough or sizable enough to make this move, right? It doesn't make a whole lot of sense. And then the loss is small, your replacement isn't solid, or the move wouldn't disrupt your long-term plan, okay? So those are the things that need to be present for this to actually play out the right way, which is very, very important. I'd also use a professional because you don't know what you don't know. And if you go in there and try to self-calculate all these things and you get this wrong, you might be way off in your assumptions or your judgment here. So let's walk through some simulations real fast. I'm going to show you an actual mathematical example that makes sense here. So using the SMART framework, we're going to do 3 examples, right? Remembering specifically the conditional logic behind the framework itself, because that's important to say yes or no. So simulation, we have the SMART goals right here. All 3. So remember, the S and the R has to be checked yes. And also at least 4 out of the 5 need to be a yes. This is just in line with this conditional logic I just walked you through, okay? So I can tell you 4 out of 5 are definitely yeses, and S and R are yeses. So therefore, should I do this? Yes, technically speaking. And I'm not saying every time this happens, you need to say yes. I'm saying this gives you the ability, the confidence to say, hey, this actually could make sense right now. But again, there's a lot of times where I'm like, it's probably not the time to do it. It's probably not right now, probably not needed. So be very critical of yourself when you do this, because a lot of people are going to do this just recklessly based on this simple framework. And this simple framework is a great start. It's a baseline, but it's not everything. So the second one, there are 4 yeses. So 4 out of 5 are checked yes. However, the R of this is checked no. And again, back to the SMART framework conditional logic, the S and R are non-negotiable. So if an S and R are checked no matter how many yeses you have, you should not be doing this. And if you look at this, why? It's because your wash sale is not avoidable, and your wash sale needs to be avoidable here. Now, the third one is 3 yeses, 2 nos. The S and R are specifically yeses. However, only 2 out of 3 are checked yes, which again, smart framework here, 4 out of 5 items you have to check yes. So therefore, we would not do this in this situation. Now, that is going to give you kind of like a real life checklist, some simulations, like real life examples as you walk through this, how you would decide. The best thing is seeing actually how this example works. So this is straight from Vanguard. This is a great example. This is a hypothetical tax savings from using tax loss harvesting. Okay. So we have 2 investments, investment A, investment B. One has a $30,000 realized, meaning they've sold this investment, they've realized this loss. It's a capital loss. Investment B, same thing. We've actually realized the sale of this specific investment B, and that's generated a $25,000 realized capital gain. So remember, tax loss harvesting explained, to kind of bring it back and wrap it into layman's terms, is first and sequentially, we're trying to reduce taxes by claiming the capital gains first. We want to offset the capital gains. Then we move to the income portion. So you have to do this in sequential order. You can't go this in reverse order. So the example shows what we're going to do here is there's 0 capital gains taxes owed on this because this $30,000 essentially negated the $25,000 gain here. So therefore, we use $25,000 in losses to offset $25,000 in gains. However, like 30 minus 25, we have a $5,000 left over. So we have $5,000 in losses. 25 minus 30, still $5,000 in losses. However, the capital gains in step 1 here, the capital gain portion, as you can see, capital gains taxes saved is $3,750. How do I calculate that? So when I look at the capital gains tax rates, depending on your income tax bracket, you're going to be either 0%, 15%, or 20% in today's tax world, okay? So your $25,000 gain that you would have paid if you did not have this loss would have resulted in a 15%, assuming you're in the 15% tax bracket, long-term capital gains tax rate, right? That's a pretty big portion. That's a $3,750 tax savings just with that move. However, there's more to the equation. Remember, the first piece is capital gains. Now, sequentially, we move to income. The second piece is we use $3,000 of the remaining $5,000 in losses to reduce their ordinary income. So now we're switching types of taxes. We went from capital gains tax with the first part of it to now the second part of it is income tax, which is a different type of tax, different rates. Obviously, we'll walk through that in a second. So let's say we save the $3,000 because you're in the tax loss harvesting world. You can only save up to $3,000 of your income, or reduce off your income. So up to $3,000, which is where this $3,000 of the $5,000 comes from. Let's say you're in a 35% tax bracket here, ordinary income tax rate. By tax loss harvesting, you're saving $1,050 just on your taxes alone. So 3,000 times 35%. Let's just say, technically speaking, you made $200,000. You subtracted out 3,000. Now you're taxed at 197 is what that's saying. Okay. So by tax loss harvesting, the investor has a total estimated tax savings of $4,800 in this exact example. The $3,750 from the capital gains taxes, the $1,050 from the income tax, and obviously each one calculated separately. Then on top of this, we can then carry forward our tax or our tax benefit that we have. So the remaining $2,000 of this $5,000 is going to be offsetting future gains. So let's say we move towards the next year, or maybe 3 years down the line. This is a carry forward loss forever. So in my accounting world, in my accounting background, you always love a deferred tax asset or something that you're carrying forward because you have a benefit down the road, essentially, is what we're saying. So that $2,000, let's say next year or the following year or 3 years from now, you decide to sell something and you have a $2,000 gain, that $2,000 will come into play at that point in time. And then you can use that for future benefit. So there are massive benefits to tax loss harvesting. It's a really great tool. However, I want you to at least at bare minimum use a smart tax loss harvesting checklist. I also want you to work with a professional to guarantee this actually makes sense for your situation. However, again, back to this alert, this is a tax strategy, not an investment strategy. And that's an important piece of the conversation because a lot of people will take this and think this is some investment, like gamifying the investments, and it's not. And it's also very detrimental if you think of it that way. So again, guys, what is tax loss harvesting? It's going to help you reduce taxes. So if you're watching this video, you get to reduce taxes. It's a good thing. But again, we're selling investments, losers of our investments to then help us on a tax basis. So we don't want to have losers, but if we do have losers, we then can use that to our benefit at a bare minimum to essentially, let's say, mitigate our loss. And when we can mitigate our losses or kind of have a softer landing, that's always a good thing to have. So that's where tax loss harvesting comes into play. I hope this was helpful and it gives you really good detail. If you have any questions, leave them in the comments below and I will get to those questions. And I appreciate you guys and I'll see you next week.